everyone. Welcome to Sam's Summaries. This episode is a deep dive into Sam Fury's summary of Swing Trading Using the 4-Hour Chart, Book 1, by Heiken-Ashi Trader. It has been created with the help of AI. It is titled Introduction to Swing Trading. You can read the original post at samfury.com.
All right, listeners, get ready because we are about to swing into action with swing trading.
Swing trading, yeah.
Yeah, and today's deep dive is all about getting you the knowledge to master it. And we've got a great source for this.
Oh, yeah?
Yeah, it's called Swing Trading, Using the 4-Hour Chart. And what's really cool about this book is that it's structured like 3 books in one.
3 books in one, wow.
Yeah, so it's pretty comprehensive.
Yeah, that's awesome, like a complete toolkit.
Exactly, a complete swing trading toolkit.
Yeah, and I think this is perfect for our listeners because we're aiming to give them everything they need to know about swing trading.
Exactly. Now, I know a lot of you listeners out there already know a thing or two about trading in general.
Of course.
So let's skip all the Trading 101 stuff and jump right into what makes swing trading special, what makes it unique.
Okay, so you see, swing trading kind of sits right between day trading and position trading.
Okay.
Yeah, so day trading is like sprinting, just intense, quick. You got to do everything fast.
Yeah, in and out.
And position trading is more like running a marathon.
Okay.
You're in it for the long haul.
Yeah.
Swing trading, on the other hand, is like a nice jog. You're capturing market movements over days, weeks, or even months, but without the constant pressure of day trading.
Yeah.
Or having to commit for a super long time, like in position trading.
So you're finding that sweet spot.
Exactly.
Where you're taking advantage of market momentum, but without staring at your computer screen 24/7.
Yeah, no, you don't have to be glued to the screen all day.
That's good.
And that's exactly why our source emphasizes the 4-hour chart, because it lets you see the bigger picture. You can see the underlying market trends.
Makes sense. I know a lot of day traders out there, they obsess over those 5-minute charts.
Oh, yeah.
They get lost in all the little details.
Yeah, it's too much noise.
Yeah.
But the 4-hour chart filters that out.
So all those little tiny fluctuations that don't really matter.
Exactly. They don't matter for swing trading.
Yep.
You're focusing on the significant swings.
Not just every little blip.
Exactly. Not every little blip on the radar.
Okay, so that's starting to paint a clearer picture for me. Now, we're talking about charts and stuff, and I noticed our source material mentions these things called Heiken-Ashi charts.
Yeah, Heiken-Ashi charts. They sound kind of complicated, right?
Yeah, they sound kind of like something out of a martial arts movie.
They do. But you know what? They're really useful.
Okay.
They're great for analyzing market trends. So you see, Heiken-Ashi charts are like a refined version of normal candlestick charts.
Okay.
Yeah, they're like smoother, easier to read. They average out the price data, which helps you see the real trend without getting confused by price spikes or dips.
So like misleading spikes and dips.
Yeah, exactly. It's like having noise-canceling headphones, but for the market.
That's a great way to put it. So it's helping you cut through the clutter and see the main price direction.
Yes, exactly.
This is really interesting. But okay, so let's say you've got your smoother charts now. But riding these market trends can't always be smooth sailing, right?
Right.
The market goes up, it goes down.
Of course, it pulls back sometimes.
How do you handle those moments when you're watching your profits go up and down and you're like, man, is this even going to work?
That's where it's super important to understand how the market works. The psychology behind it,
Yeah.
And mastering risk management, those are like your 2 most important tools. Because you see, even in a strong uptrend, there will be those little periods where the price goes down a bit or it just stays flat.
Yeah.
The real trick is being able to tell the difference between those normal fluctuations and a true trend reversal.
I can imagine that's easier said than done, though.
It is, especially when you see your profits shrinking and you think, oh, no, maybe this is the end.
Right.
That's why our source really emphasizes the importance of setting stop-loss orders.
Stop-loss orders. Okay.
Yeah, it's about knowing how much risk you're willing to take and basically setting up your trade so that if it moves against you past a certain point,
Yeah.
it automatically exits the trade.
Like a safety net.
Exactly. Think of it like a safety net.
Okay, that makes sense. But, I was thinking, if you set those stop losses too tight, won't that cause you to miss out on some gains if the market just, dips down a little bit before going back up?
Yeah, it's all about balance, right?
Yeah.
You got to find that sweet spot.
Yeah.
And actually, this is where the book gets really interesting, especially when it dives into the 1% rule.
Okay, hold on. Before we get to the 1% rule, I do want to talk about the different markets you can swing trade in.
Sure.
So I know our source mentions shares being a popular choice.
Yeah. Shares, they're great because there's so many different options to choose from
Yeah.
and the potential for some really big price swings.
Oh, okay.
But there's a downside to shares. They only trade during certain hours,
Ah, okay.
which means you could run into price gaps.
What do you mean?
Like imagine you buy a stock, you go to sleep, wake up the next morning, and bam, the stock is like dropped 10% overnight.
Oh, because of some news or something?
Yeah, exactly.
Yeah.
Some news event that happened overnight while the market was closed.
So you're just stuck.
Pretty much. You're stuck with that loss.
Okay, so what's the alternative? If shares are risky like that.
Currencies.
Mm-hmm.
Currencies trade almost all the time, so there's a much lower risk of price gaps.
Ah, okay.
Great for beginners
Yeah.
because you can start with smaller
Positions.
positions.
Yeah, like micro lots.
Micro lots, okay.
Yeah, so you don't have to risk as much money when you're first starting out.
That sounds a lot less scary than waking up to a huge loss.
But, I do have a question about getting a feel for the overall market, like the big picture.
Yeah.
Our source mentions this idea of having a basket of like 16 instruments you keep an eye on,
Right, yeah.
like a market dashboard.
Right.
What's the thinking behind that?
It's a really smart idea. So by tracking a mix of different things, indices like the DAX and the Dow Jones,
Yeah.
commodities like oil and gold,
Mm-hmm.
and major currencies,
Mm.
you get a really good sense of how all the global markets are connected. It's all one big system, right?
Right.
So it's like you're taking the pulse of the global economy.
Ah. Oh.
Okay, yeah, it's not just about picking individual assets.
Right.
It's about seeing how all the different pieces of the puzzle fit together.
So how they influence each other.
Exactly. For example, if the price of oil goes way up,
Yeah.
that's going to impact transportation costs. Right.
Makes sense.
And that can then impact the stock prices of companies involved in transportation.
Aha. Okay.
So you can use that knowledge to anticipate how the markets might move.
That's pretty cool. Now, I know a lot of our listeners, they're big fans of ETFs.
Yeah, ETFs.
Yeah, they seem like a great way to get into a specific sector without having to pick individual stocks.
Yeah.
So where do ETFs fit into this whole swing trading picture?
Oh, they're great for swing trading.
Okay.
You can trade them just like stocks.
Well.
But you get the benefit of diversification, meaning you're not putting all your eggs in one basket.
Right. Yeah.
So let's say you want to invest in renewable energy, right?
Yeah.
Instead of researching dozens of individual solar panel companies or wind turbine companies, you could just buy an ETF that tracks the entire renewable energy sector.
Ah. Okay. So you're riding that whole wave.
Exactly. You're riding the whole wave without getting bogged down in the details of each individual company.
That's smart. But, speaking of different trading instruments, I noticed that our source material actually advises against trading futures and CFDs.
Yeah, especially for beginners.
Especially for beginners. Why is that?
Well, you see, futures and CFDs, they offer high leverage.
Yeah.
Which means you can control a really big position with just a small amount of money.
Yeah, it's tempting, right?
It is. It sounds great, but it's super risky.
Oh,
Yeah.
yeah.
Because high leverage magnifies both your profits and your losses.
So it can go both ways.
Exactly. And if you're still learning how to trade,
Yeah.
it can wipe out your entire account really quickly.
Oh, okay. That's not good.
Yeah. Our source recommends sticking to currencies or ETFs.
Yeah.
At least when you're first starting out. It's just safer that way.
Okay, so starting with a solid foundation, understanding the basics, and managing your risk.
Yeah,
Those are all really important.
absolutely.
Okay, so before we jump ahead into the specific setups for swing trading, I done want to come back to that 1% rule you mentioned.
Oh, yeah. The 1% rule, it's a really simple idea,
Okay.
but it can make a huge difference in your trading.
In what way?
Well, it's not just about protecting your money,
Okay.
which is super important, of course.
Right.
But it's also about managing your emotions.
Your emotions.
Yeah, like when you limit your risk on each trade,
Yeah.
you're less likely to panic when the market does something unexpected.
Okay, that makes sense. You're not going to be like freaking out every time the price moves against you.
Exactly. And the 1% rule basically ensures that even if you have a few losses in a row,
Yeah.
it won't wipe out your entire account.
You'll still be in the game.
Exactly.
Right.
It gives you the staying power to keep learning and improving your strategy.
So it's not about never losing money.
No.
It's about controlling those losses.
Exactly. It's about controlling your losses and being able to come back from them.
Okay, so it's about shifting your mindset
Yes.
to be more long-term focused
Exactly. And it allows you to focus on getting better at trading.
rather than just constantly worrying about losing all your money.
Exactly. You're focusing on the process of improving your skills.
Okay, so the 1% rule that sets the foundation for a good trading mindset.
Right.
but how do you actually use it? Like, let's say I have $10,000 in my trading account.
Okay.
Does that mean I can never risk more than $100 on a single trade?
Yeah, but that's the general idea, but it's not just about picking some random dollar amount.
Okay.
You also have to think about things like where you enter the trade,
Okay.
where you set your stop loss, and how volatile the asset is.
Volatile.
Yeah, so there's a little bit of math involved.
Okay, this is where that position sizing thing comes in, right?
Exactly. Position sizing is all about figuring out how much to buy or sell
Okay.
based on your risk tolerance and that potential loss that you've defined with your stop loss order.
Okay, so you're not overexposed if the trade goes against you.
Right, exactly. You don't want to be betting the farm on every single trade.
Right. But what about those stop losses? If you set them too tight, won't they get triggered too easily?
That's the challenge, right? You want to give your trade some space to move around,
Yeah.
but you also want to protect yourself from big losses.
Right.
So our source suggests placing your stop loss just below a recent swing low if you're buying,
Okay.
or just above a recent swing high if you're selling.
Okay.
Those previous price points often act as support and resistance levels.
So you're using the market's own behavior.
Exactly. You're using the market's behavior to help you manage your risk.
That's pretty cool. But there's also that average true range thing, right?
Yes. So the ATR basically measures how much an asset's price fluctuates on average over a certain period of time.
Okay. But what is volatility exactly?
It's just a fancy way of saying how much the price moves up and down.
Oh.
Like a tech stock. That might be really volatile. The price jumps all over the place.
Yeah.
But something like a blue chip stock or a currency pair, that might be less volatile.
Okay.
So the ATR gives you a number for that volatility,
Okay.
which helps you decide how much wiggle room to give your trades.
So if the ATR is high,
You set a wider stop loss.
wider stop loss. Okay.
Exactly. You got to adjust your stop loss based on the personality of the asset you're trading.
So it's like each asset has its own little personality.
Yeah, they do.
That's funny. Okay. I'm starting to see how all of this fits together.
Good.
The charts, the risk management, understanding the psychology of the market.
Yeah, it's all connected.
But I gotta be honest, setting those stop losses, like actually doing it,
Yeah,
that seems kind of emotionally hard.
it is. It's not easy to accept that you might be wrong about a trade,
Yeah.
but that's what stop losses are for.
Yeah.
They protect you from those massive losses that can really hurt.
It's like cutting your losses short.
Exactly. It's about surviving to trade another day.
Okay, so it's not about being right or wrong all the time.
No.
It's about staying in the game.
Exactly. Think about it like baseball. Even the best players strike out sometimes.
Yeah.
But they don't let those strikeouts stop them from playing the game.
Okay.
They learn from their mistakes, they adjust their approach, and they step back up to the plate.
I like that analogy. Speaking of learning from your experiences, you know our source talks a lot about keeping a trading journal.
Yes, the trading journal. It's so important.
Why is that?
Because it's like having your own personal trading coach.
Ah,
By
okay.
writing down everything about your trades.
Like what?
Your entry point, your exit point, why you made the trade, how you were feeling at the time, and whether you made money or lost money.
Yeah.
You create this really valuable record of your trading journey.
So you can see patterns.
Exactly. You can see patterns in the market and in your own behavior.
So you might notice that you tend to make impulsive trades when you're stressed out.
Exactly. Or maybe you always exit trades too early because you're afraid of losing your profits.
Ah, okay. That makes sense.
A trading journal helps you bring all those hidden patterns to the surface.
So it's not just about tracking numbers.
No.
It's about understanding yourself as a trader.
Exactly. Self-awareness is key to becoming a consistently profitable trader.
Now, we talked about those fake moves in the market.
Yeah.
Those false breakouts, bull traps, all that stuff.
Right.
Is there a way to spot those before you get caught?
Definitely.
Yeah.
And remember those Heikin-Ashi charts we talked about?
Yeah.
They're really helpful for this because they smooth out the price action.
Okay.
So you can see more clearly whether a breakout is real or just a head fake.
Ah, okay. So they're like a lie detector for the market.
That's a great way to put it.
But are there any specific setups that are like red flags, that scream, this is a trap?
Oh, yeah, definitely. Like a classic bull trap. That often happens after a long downtrend.
Okay.
The price breaks above a resistance level.
Yeah.
Everyone gets excited. They think the trend is reversing.
Yeah.
But then, bam, the price reverses and plummets back down.
So everyone who bought in at that breakout level, they get trapped.
Exactly. It's like the market is setting a trap for those bulls.
Okay, what about those dead cat bounces?
Dead cat bounce.
Yeah.
Oh, yeah. Those are tricky, too. So imagine a stock that's been falling and falling and falling.
Okay.
Then suddenly it has this little rally.
Okay.
Makes you think, maybe it's recovering.
Yeah.
But it's usually just a temporary thing.
Ah, Okay.
It's often just short sellers covering your positions.
Short sellers.
Yeah, people who are betting that the price will go down.
Okay.
So when they buy back those shares to cover their positions,
Yeah.
it creates a little surge of buying pressure.
Ah. Okay, but then the downtrend continues.
Exactly. The dead cat bounces, but then it falls right back down.
Okay, so how can you tell the difference between a real breakout and a fake breakout?
The amount of trading activity,
Okay.
a genuine breakout, usually has a big surge in volume.
Okay.
It's like a confirmation that something real is happening.
So if the volume is low,
It's probably a fake out.
but it's all smoke and mirrors?
Exactly. A real breakout is like a rocket launch. It's got all this power behind it.
Yeah.
But a fake breakout is like a firework. It's all flashy, but there's no real substance.
Okay, so you're not just chasing any price surge.
No, you got to be patient.
Patient. Okay.
Don't jump into trades just because you're afraid of missing out.
Right.
Wait for confirmation.
Confirmation. Okay.
Look at the volume
Yeah.
and trust your analysis.
Okay, that makes sense. So before we move on, I have one more question about stop loss orders.
All right, shoot.
Is there like a perfect formula for figuring out where to put your stop loss?
Unfortunately, there's no magic formula, but there are some guidelines you can follow. It's not just about buying and selling, that's for sure.
Right, it's about charts and risk and psychology and all these things.
Exactly. And one thing our source really emphasizes is the importance of never stopping learning. You know,
Right.
the markets are always changing. What works today might not work tomorrow.
So you got to be adaptable.
Exactly. You got to stay flexible and constantly test and refine your approach.
It's almost like a science experiment, you know?
I like that analogy.
Yeah, you have your hypothesis, which is your trading strategy, and then you're gathering data to see if it holds up in the real world.
That's a great way to think about it. And that's where back testing comes in.
Back testing.
Yeah, it's basically like running simulations using historical market data. You're testing your strategy to see how it would have performed in the past.
Without risking any real money.
That's the beauty of it.
So you can see what works and what doesn't.
Right. You can identify any weaknesses in your strategy.
Refine your entry and exit points.
Exactly. And optimize your risk management.
Okay, but isn't there a risk of over-optimizing? Like if you tweak your strategy too much to fit the past data?
Yeah, that's a valid point. You don't want to create a strategy that works perfectly in the past but fails miserably in the present.
Right.
It's all about balance. Back testing helps you validate your strategy.
But the market's still unpredictable.
Exactly. There's no way to predict the future with 100% accuracy.
So you're looking for a strategy that has an edge.
Right, something that gives you a higher probability of winning over the long term.
Okay, and that's where the trading journal comes in again, right?
Absolutely.
Yeah.
By keeping track of all your trades and your thoughts and emotions, you can really start to understand yourself as a trader.
You can see those patterns in your behavior?
Yeah, those little things that might be sabotaging your results.
Like what?
Well, maybe you notice that you always second-guess yourself after a losing trade.
Okay.
Or maybe you get too excited and start chasing trades when the market is volatile.
Right.
The journal helps you become aware of those patterns.
So you can break those bad habits.
Exactly. Self-awareness is so important for any trader.
Now, our source also mentions the importance of patience in swing trading.
Oh yeah, patience is key.
It's not like day trading where you're in and out of trades really quickly.
Right, swing trading is more about waiting for those big price swings.
Those trends that take time to develop.
Exactly. It's not about jumping on every little price movement. You have to be disciplined and resist the temptation to overtrade.
Okay, so it's about having a plan and sticking to it.
And not letting your emotions get the better of you.
But what about the mental side of things? Isn't it hard to just sit there and wait?
It can be, but that's where mindfulness comes in.
Mindfulness, like meditation and stuff.
Yeah. It's about being present in the moment, aware of your thoughts and feelings, but not letting them control you.
So it's about staying calm and focused.
Exactly. And not letting the market's ups and downs throw you off balance.
That makes sense. So it's like a mental training.
It is. It's like training your mind to be more disciplined and resilient.
I'm starting to see that swing trading is not just about technical skills.
Right.
It's also about developing the right mindset.
Absolutely. It's about mastering your emotions, managing your risk, and having the patience to wait for the right opportunities.
This has been such an insightful deep dive.
It has. We've learned so much.
Yeah, I'm feeling a lot more confident about swing trading now.
Me too. And remember, the learning never stops. The markets are always evolving.
So we have to keep learning and adapting.
And that's what makes trading so exciting.
Well, to all our listeners out there, we hope you've enjoyed this deep dive into the world of swing trading.
Happy trading, everyone.
Thanks for tuning in to Sam's Summaries. If you found this episode useful, let us know with a like, follow, and share. Also, if you haven't already, be sure to visit samfury.com to get free access to all of Sam's original summaries. You can also get any of Sam's books and other exclusive content. It's all completely free at samfury.com.